How do markets move? Cycles and waves. The effect of cycles on the market. Over the past 200 years, much has been written about cycles, some of it very useful and some of it not so applicable to trading success. Cycles are evident in nature, in the form of the Earth's rotation, days, the Earth's rotation around the Sun, the years, the Moon's rotation around the Earth, tides, the seasons, animal migration, and even solar activity. Some traders believe natural cycles have an effect on the market, and in some ways they do. For example, weather cycles have an effect on crop output, which can affect commodity prices, which in turn affect the stock price of a company dependent upon the commodity. However, there are other cycles which can be useful for more general stock market activity. The effect of cycles on the stock market, on the economy and marketplace and business is clear. In this section, we will take a look into the theory of cycles and look at how we can apply them to improve our understanding of market fluctuations and major moves. This will in turn enable us to make better trading decisions. The most famous of cycles are cited in the chart you see here. Here, across the top, we can see the years plotted from 0 to 60 years. And you can see here the longest wave, commonly understood as the contractif wave, which is 46 to 60 years, averaging 54 years. The Kuznets cycle, which for a full wave to take place takes approximately 18.3 years. The Juggler cycle, 9.2 years. And of course, a complete wave is from peak to the next peak, or from trough to the next trough. So the Juggler cycle is 9.2 years. Then we have the kitchen cycle, or more commonly known as the business cycle, which is circa 4 years from peak to peak, or also the presidential cycle, which is also approximately 4 years. And of course we have seasonal cycles, which you can see here along the bottom. The contractif wave. The contractif wave measures between 46 and 60 years with a periodicity of 54 years. Based on wholesale prices in the US in the 1800s, this phenomenon has been mapped from the 1800s through to today. The last trough was 1940, and the prediction for a trough in 2000 seemed to be correct. However, to see if this cycle theory proves correct again, we will have to wait another 40 to 50 years. How actionable this data is another question. Normally, using statistical data, a trend or theory is proven after 12 to 16 data points, which we certainly do not have here. Also, this theory is quite controversial in the annals of economists. Is it a tradable cycle? Well, not really.